Tony Pasquariello, Global Head of Hedge Fund Coverage at Goldman Sachs, back to Post 9. Welcome back.
Thanks, Scott.
What's your base case, do you think, for 25?
Well, it's been a terrific year for U.S. equities. Total rate of return for S&P 500 plus 29%. More locally, up 11 in the past 12 days. I think there's still gas in the tank as we move through December and into 25. I say that for a few reasons. The economy is performing well. We've got U.S. GDP growth plus 2.5% for this quarter, plus 2.5% for full year next year. Financial conditions remain easy. I'm sure we'll talk about the Fed. Would they? Yeah. Should they? But the fact is right now, financial conditions are very accommodated for forward growth. And then you have the technical side of the equation. Flow of funds running net positive. The biggest holder of the asset class, which is households, are on the bid. The biggest buyer of the asset class, which is corporates, are on the bid in the form of buybacks. It's the world's best-known secret. Seasonals this time of year, very favorable. And so I think this momentum probably continues through the month and then into the start of next year.
Just to the start? I mean, when you say that there's still gas in the tank, do we have a quarter tank or do we have, like, almost full? Now, did we just refill the tank? I should probably better say.
Right.
With the new administration coming in, that's just going to be more growth friendly. I don't know how else to put it.
I think that's right. No, I still think it is a bull market. I still think the primary trend is higher. If we're right on growth, if we're right on Fed, if we're right on technology, the raw ingredients are, would argue for the rally to continue. Now, is risk reward the same today that it was a year ago or 2 years ago? No. Is valuation more demanding at 22.5 times? Yes. But again, big picture, the primary trend is still higher through next year.
Market goes up next year because of better earnings growth or multiple expansions. Kind of hard to get both. What do you think?
If I had to pick one, given that we're forecasting S&P earnings growth plus 11% next year, I'm going with earnings growth. And it's what you said, which is, I think, look, there's a lot of unknown variables in the political equation. Trade/tariffs, taxes, regulation, immigration. There's a lot we don't know. I think in the end, though, you hit the key point, which is my expectation is the next administration will be operating from a pro-business, pro-cyclical bias.
Does the Fed add fuel to the growth fire, or does it snuff it out a little bit because it waits too long or it's too patient, too cautious to move too quickly? What do you think?
Our expectation is the Fed goes in December, January and March, 2 more times next year. So when we're sitting here in June, the funds rate is 3 3/8.
Okay.
That's a little bit more than the bond market and than the strip prices. So on net, I still think part of the story this year is you've had, like I said, you've had a strong growth backdrop. We think that continues. And alongside that, the Fed has a good hand to play, and they can continue to deliver these adjustment cuts.
I mean, that's the point that Powell continues to make.
Exactly
the
correct.
The hand that he thinks he has. He's got a lot of cards, right, that he can play.
Correct.
And he can be patient in how he plays them before he throws them. He doesn't want to throw everything on the table now. He doesn't have to.
That's right. And I think I'm kind of of two minds on this. On one hand, you'd say the unemployment rate went from 3.4% to 4.1%. We know lower income households and small businesses have been under pressure. So that would argue for more of what he's been delivering. The other side of the equation is, like I said, growth is fine. I look at the equity market. It's not obvious to me that, like, liquidity is too tight, right? Risky assets are screaming most everywhere I look within the U.S. So I think, again, Powell goes on the 18th. That's 100 basis points in his pocket, and he has 6 weeks for some of these other cards to turn over policy-wise.
So if you're optimistic about growth, do you think that you edge towards equal weight because you think the broadening is going to continue? Today and recently, right, we have this resurgence in tech, which would kind of call that into a little bit of question. And you said if we're right on the Fed and if we're right on tech. What does being right on tech mean? What's your view?
So I still like tech. I still believe it manifests these elements of both sword and shield. We sit here today, the Magnificent Seven is up another 58% this year. That's worth $5 trillion of market cap creation. It's some form of magic. I think you have to ask yourself the question, can it deliver as much torque next year as it's delivered this year? But again, I say it all the time, you don't want to constrain your imagination around these companies. They're the best companies on the planet with the best balance sheets on the planet. There's a reason NASDAQ's up 15 of the past 16 years.